Hi, folks. Welcome to the Getting Your Edge podcast. My name is Dennis.
And hi, I'm Judy Gratton.
And we're here to help you right-size your home and your life.
On my hair. Good day, everyone. This is episode 13 of the Getting Your Edge, How to Right Size Your Home and Life podcast, brought to you by the fabulous Edge Group team. I'm here with my guest host, Judy Gratton. How are you today, Judy?
I'm really good. How are you?
Great. And we have an excellent speaker.
Ready? Spring?
I'm sorry, say again?
Ready for spring?
Yes, I hear it's coming this week, so I'm excited.
Good.
It's been a cold, long winter.
Yes.
So we have a special guest here today. This is Richard Morse. And Richard, can you do a little introduction of who you are and your business?
You betcha. And good morning, good afternoon. 13 is my lucky number, by the way, so that's a good thing. My name is Rich Morse. I'm an attorney. I joined the bar in 1982, Idaho Bar in 2021, and founded Washington Exchange Services in 1994.
We want to save you some money on capital gains. So we kind of have a couple of scenarios here. Richard's going to talk to us about something called a 1031 exchange, and this is a legal way of saving on capital gains. And one scenario would be if you have an investment property or vacation property, and the other one would be if you were selling your home. Let's say you're downsizing. Might be that you want to downsize to a smaller thing, but keep your home as a rental property.
Okay, so Richard, I have worked with Richard for years, and I've taken many classes from Richard trying to understand what a 1031 exchange is, because it is a bit complicated. So Richard, could you tell us a little bit about what a 1031 exchange is and how it works?
Sure. Tax-deferred exchanges were formed by Congress in 1921. They've been around a long time. I generally refer to them as a legally sanctioned fairy tale because the taxpayer is actually going to sell a property and buy a property, and those sales and purchases will work like any other sale or purchase. There's just an overlay with the tax code of how to qualify the characterization of a sale as a 1031 exchange. So it's like any other real estate transaction with a sale and a purchase. It just happens to deal with the particular tax statute, Section 1031, which pertains to selling something that is held for trade, business, investment purposes. That means a person is thinking of selling something that at the time is other than a primary or secondary residence, and that they're considering acquiring one or more what are called replacement properties that initially will also be other than a primary or secondary residence. Any interest in real estate is deemed like kind for any other interest in real estate. So raw land could go for an improved property, duplex for an office building, so forth.
A person can't sell their home and then use this 1031 exchange if it's their primary, correct?
No, it use the primary residence exclusion, which is still, as of today, you've lived in it, the primary residence, as a primary residence 2 out of 5 years. If you're single, you get $250,000 of gain. That's not equity. That's gain tax-free. Married couples get $500,000 of gain tax-free. The rest, any other gain, they pay capital gain tax on it.
So could you explain how that works, gain versus equity? Is that the bottom dollar from the...
Right. So realized gain, is the difference between what is the net sales price and adjusted basis. With a primary residence, it would be your basis is your cost basis plus any capital improvements, roof you put on or so forth. The difference between that number and the sale price of your residence, less closing costs. The closing costs are the same characterization for exchanges as well as primary residences. So I'm selling for $110,000. be it my residence or a rental property. I have $10,000 of real estate commission, excise tax, title, and escrow fees. I subtract those. I'm saying my net sales price is $100,000. If I bought my home for $20,000, then that's $80,000 of gain. Those numbers work the same with an income property, except that there would be depreciation. So with income property, realized gain is the difference between the same net sales price and the adjusted basis, which is the purchase price plus the same capital improvements minus depreciation equals you subtract that, and that's your realized gain. If you sell, you pay tax on that gain. So in my hypothetical $80,000 gain, you pay tax on that. Sometimes people will use the word profit, and profit is irrelevant for tax purposes. I think what they mean is I bought it for $100,000, I'm selling it for $300,000, I made a $200,000 profit. And that kind of makes sense, but that's not the realm of 1031 exchanges. I keep going on this, so I'll just kind of stop there. I got excited in tax and law school, particularly with exchanges. Who knew that I'd be focusing a business on them many years later? So there we go.
So this is a way to defer taxes on investment properties. Tell us what kind of investment properties qualify.
So again, really, I'm selling something at the time of the sale is other than a primary, or it has to be a domestic property. Well, you can do international exchanges, but that's another ballgame. I'm selling something within the 50 states. I maybe bought it as a primary residence years ago, lived in it. Often the scenario is I got married and my wife and I bought a new home. We turned my original home into a rental. Okay, so we recharacterized it from a primary residence to a rental. And now today, 4 years later, I'm going to sell that rental. Then I could structure that as an exchange because at the time of the sale is other than a primary or secondary residence. And I can then go buy any other interest in real estate anywhere in the country, so long as initially the property will be other than a primary or secondary residence. So a lot of times I get people who are saying, I'm going to retire in a couple of years. I want to sell my Linwood rental. And usually it's in pretty nice places like Maui. And let me go buy a condo in Maui. I'll rent it for a couple of years in the future, and then I'll move in or turn it into a second residence. That's all in the light of day and sleep at night.
You had referred to this as kind of a fantasy. So
right.
What do you mean by that? Because it sounds really easy. Okay, I'm going to buy this property. I'm going to sell this one and buy this one. But there's quite a bit that goes in between those two transactions. And I think that's where the fantasy lies, right?
Yeah, well, you're absolutely right, Judy. I just say it's a fiction because it's a sale and a purchase. The IRS knows you're selling and you're buying, and your settlement statement with escrow looks like any other transaction. There's just like an overlay. I keep thinking of the frogs in the old encyclopedia. There's an overlay of the tax code that then so a person who's engaging in an exchange, selling a rental, would need to retain services like my company or any other qualified intermediary, because the code says you have to have, and I'll abbreviate it as a QI, qualified intermediary. So if Sally wants to sell her rental and use the 1031 statute, she has to have a qualified intermediary like my company before she closes her sale, because the trade is actually, so we're saying this is an exchange, a trade is with the QI, so that Sally can sell to any buyer and buy from any seller because the exchange is with the QI. The complexities come into the time periods involved, and then the actual structure, which for the most part, the principles, the exchanger isn't involved in. The exchanger goes to escrow on a sale or a purchase. They sign all the usual sale documents. To initiate an exchange, they would simply sign additional documents, exchange documents, and that brings the transaction within the qualifications of 1031. So really for the principal, all they're doing is going to escrow and signing some additional going out, working with you to list a property, going out with you to find a replacement property, get a loan. All of that is as any other transaction.
Except we do have to declare when we are doing a 1031 exchange on the listing for certain. I'm not sure if you have to declare that on the purchase. Do you?
No, I don't, because this has nothing to do with the buyer. The other parties are relevant. That's why the trade is with the QI, the intermediary. So Sally's selling her rental to Bob, who's going to live in it, and she's going to go buy George's primary residence and turn it into a rental. That doesn't matter. And people will say, well, do I need to put special language in the purchase and sale agreement? Fortunately, the multiple listing service is the best contract I've seen across the country. And I've done deals in most states, and I really like the multiple contract, which includes the 1031 language, because the contract, I think, is real clear. Idaho and California have terrible contracts. They have so many disclosures. I had trouble understanding them, but I really like the contract. It's really clear.
So, Richard, are there a lot of restrictions about what a person can do in this 1031 exchange?
Well, you have several questions in there, but one is, what can you do with an exchange? You can sell other than a primary or secondary residence and buy other than a primary or secondary residence. For the most part, a person calls me up and says, hey, can I do this? My general answer is yes, with maybe an asterisk associated with it, because usually the tax code does not get in the way of the deal, meaning get in the way of what the person wants to do. The two instances where the tax code can get in the way of the deal is a related party exchange, which is fairly rare, just factually. The IRS, for no good reason, does not like a related party exchange. A related party exchange is son sells his duplex and wants to buy mom's 10-unit apartment, and mom's going to pay tax on her way out. And the code doesn't like that because they call it basis shifting, and it never has anything. Basis shifting never has anything to do. So related parties can be a challenge, and on the tax form used to report an exchange, which is 8824-8824, it asks, is this a related party? So it's kind of a high profile posture. The other situation where the code gets in the way of the deal, and this comes up frequently, multi-member LLCs. So a person will call up and says, hi, we are thinking of selling, or we're going to sell, and when are you going to close? End of the month. And then I hear that plural pronoun, we're going to sell. So I ask, well, how is the property titled and vested? Well, there's an LLC. It's vested in an LLC, Green Lake LLC. Okay. How many members are there? Oh, there's 3 of us. Well, right then and there, they got a problem, and they don't know it. And unfortunately, the accountant or the attorney who created the LLC didn't appreciate 1031 law, because a multiple member LLC means, so we've got Green Lake LLC, and the 3 of us are members of that LLC. That's fine and dandy. The Green Lake LLC, we can decide to go do an exchange with our LLC. But usually the factual setting is that Judy wants to sell. We all want to sell, but Judy wants to take her cash and go home. And I want to go forward with an exchange. Well, the property is vested in the LLC, and for purposes of the IRS considers the real estate interest, the interest in real estate, to be held by the entity, not by us individually. So it's sort of like we're passengers on a bus, and the bus is the LLC, and the bus can do an exchange, but usually, factually, 1 or more members want to get off the bus, and there's someone remaining on the bus who wants to do an exchange, and it can get complicated how to utilize that existing LLC in the exchange. Whereas if instead we were each tenants in common, so we each had our own individual interest in real estate, which for liability purposes, we would put our respective tenant in common interest in our own individual LLC for liability purposes, then the 3 of us make a decision to sell. We could choose as individuals to stay together, or one of us goes home and the other person does an exchange. They can do whatever they want, because it's the same thing as if we're tenants in common, as if we own 3 separate properties. I own one in the north side of the town, you own one, Dennis, on the south, and Judy's on the east side. It's the same factual setting. It's just we just so happen to have a common interest in one building. So those are the two instances where the code gets in the way of the deal. You touched on time periods, and that is important. If we close the sale today, which means record, then tomorrow, two time periods begin running, and they run concurrently. They run together, and they run on calendar days. So holidays and Sundays all count the same. So that tomorrow would be the beginning of two time periods. One is the 180-day replacement period, which is essentially 6 months. It rarely has any play on the transaction unless the client wants to do a to-be built or an improvement to exchange. Then that time period is very relevant, but usually otherwise it's not. The other time period is significant. It's a 45-day identification period, a month and a half, which means, and I'm just going to have to go over this rather quickly, is if I close the sale today, tomorrow the 45-day begins. I have 45 days left to what's called identify up to 3 replacement properties as of midnight the 45th day. And if I did that, today's the 45th day, I retain the flexibility to buy 1, 2, or all 3 of those properties. If I want to diversify and go into more properties, then another rule kicks in, which means essentially if I want to go and buy 4 or more properties, I identify them. I have to buy all of them or the exchange fails. That, again, factually is pretty rare. But what I encourage parties is that if we're closing the sale today, the client, already started working with Judy and you a month ago, beginning to look for the replacement property while, I'll keep saying it's Sally's property we're selling. So Sally got into contract a month ago to sell. She should be out now this month, coming up now, closing with Judy, looking for other replacement properties. So hopefully when you close your sale, you already done your due diligence or are through a lot of the due diligence so that if the deal doesn't work out, you can rescind and go start, a new transaction, a new offer. So hopefully you're not on the 45th day kind of, throwing darts at a wall. What do I want to buy? Because if those properties, you don't need to be in contract to identify them. They don't even need to be on the market, technically. Just we would give the client a form. They'd write down 1, 2, 3 Cherry Lane, Seattle. They've identified it. You can identify, revoke all you want. But if today's the 45th day and Sally's identified 1, 2, 3 Cherry Lane and it burns down tomorrow, she's out of luck. You want to plan ahead is what I really encourage parties when they're calling me. Work with their agents early on price, type, location. What's the price range? What's my net equity coming out? So what loan do I want? What price range am I looking for? What type of property am I looking for? And where do I want it? Your agent can be out looking for those properties, hopefully before you even close your sale.
In the past 2 or 3 years, it was identifying a home that you wanted didn't necessarily mean you were going to get it. And
right.
So that, I think, added another little bit of confusion to this pie that we're talking about. When you said they can identify up to 3 properties to the 45th day and they identify them, what if they can't close on any one of them?
They're out of luck.
And when you say out of luck, you mean that they will now pay capital gains on the property they just sold, correct?
Correct.
Okay.
So, what happens is then the person says, when should a person consider doing an exchange? And I try to use, I say it's a no-brainer. The first taxes never run the show. But that, if a person's made the business decision, and we're talking about a rental property, usually is what it is. They made the business decision to sell it. They've made the business decision they want to reinvest. And I say if they've got taxes of $10,000 to $15,000, I just pick that number, then I think it's a no-brainer to start the transaction as an exchange, because what they're really telling me is, Rich, I've made up my mind. I'm going to do what I'm going to do. I'm going to sell and I'm going to buy. And then the only question is it worth, structuring it as an exchange, which means, is it worth paying an intermediary like me a fee to do the transaction? And, I just pick 10 to 15. It's a 15% capital gain rate. So $15,000 of $100,000 of gain. I had a client buy in Idaho a couple of years ago. He saved net $7,000. he was thrilled because he was doing what he was going to do anyway. But then there'll be the person who says, well, yeah, I want to sell and I want to buy, but, right, Judy, what happens if, and there, you can tell them, well, Sally, there's real demand for your property. You're going to get the market price you want, all hunky-dory. And Sally says, yeah, but what if I don't find the replacement property in time? I want to buy, but what if I don't find it? So then I don't sell. And as I said to Dennis, one of the things I think we should at least touch on is that there can be reverse exchanges where you buy before you sell. And particularly the period you referred to, Judy, the last 3-4 years where the market was just so hot, sellers, and this is nationwide, that was what I found, sellers were not willing to wait other than the time it took for a buyer's loan to process, which is about a month.
Right.
And I would sellers that my clients sellers where they would need like 5 weeks or 6 weeks. The sellers wouldn't wait because they didn't need to. In instances like that, then at times they did look at a reverse exchange, which means they bought before they sold. And the benefit of that is, well, if I get control of my replacement property, I control my currently owned property by price and terms. I get 6 months to close. If I buy my replacement property today in a reverse, I get 6 months to close my sale. Judy, you already told me I'm going to get market price real fast with mine. So I'm virtually assured of a successful exchange because I got control of my replacement property first. And ideally, I always want to do a sale, then a purchase. But depending upon market conditions, you find a good property because you've been out looking for that person and you found it. Well, okay, their property is going to close in a month, your client, and you already went out and found a replacement property that the client says, well, gee, that is my price type location. That's when they can't get that seller to wait to consider doing a reverse.
Wow. And I didn't even know a reverse was something that you could do.
The good thing is that you as an agent,
something.
your scope of agency is unaffected by an exchange. So, you've been a real estate agent forever. You're an expert in your field. That's your scope of agency. The Sally we're referring to that she wants to do an exchange has no effect whatsoever on your scope of agency. But, the more informed you are, the better value and you can convey to your client, the better, easier it is to communicate. But none of this stuff we're talking about is your responsibility. But I've had new agents say, oh, well, I'm intimidated. Or I'll hear a person say, oh, well, I've never done an exchange. And I try to reassure them, don't worry about it. It has nothing to do with you, except my job is to make you look good, which for you, Judy, is very easy.
Well, thank you so much.
That's easy because you're sharp.
Do we have any potential risk to doing a 1031 exchange?
Yeah, I saw that question. I think the first one that comes to my mind is I don't find a successful replacement property. And in the example I gave, by the way, I've made a business decision to sell and buy, and I got $15,000 in taxes. It is possible to also do a partial exchange. I'm selling for $110,000 and I got $10,000 in closing costs. My net sales price is $100,000. To pay no tax, there's other things I gotta do, but keep it simple. I gotta buy one or more properties, cumulative values equal to $100,000. Well, I don't find anything for 100 or 110 that makes good business sense. I find something for 90,000 that makes good business sense, so I'm going to buy that. I'm not going to do something stupid because of the tax bill. Well, then Sally's going to pay $10,000 and pay tax on that $10,000, going down from 100 to 90,000 purchase price. Should she still do an exchange, even though she's paying tax? And I say to folks, yeah, just like in the beginning, you made your decision to sell and buy, and even if you're going to pay tax, and I've had people, say, hey, I want to have $50,000 in my pocket because I want to go buy bubble gum or buy a car or whatever. They're going to pay tax on that 50. Should they still do an exchange? And depending upon the amount of gain they have, it can still be a no-brainer that I'm still, by doing an exchange, I'm going to save or preserve capital of a meaningful amount of money, even though I'm paying tax. And I say a meaningful amount, just to pick a number, is 10 to 15,000. So you can do partial exchanges too. You can buy with other people as well. the code rarely gets in the way of the deal.
What are the cash and mortgage boot rules? I see that's one of our.
Right. So, my standard hypothetical is I'm selling for $110,000 and $10,000 in closing costs. So my net sales price is $100,000, and I got a low adjusted basis of $20,000. So purchase price plus capital improvements minus depreciation equals $20,000. Therefore, if my net sales price is $100,000, I have $80,000 of potential taxable gain. I gotta have a QI before I close my sale. I have to buy $100,000 or more within 6 months. 6 months is not a big deal. And then let's say I'm paying off a $40,000 loan. So when I close my sale, Sally closes her sale today. She has two types of what are called boot, which is just jargon for non-like-kind consideration, because these are like-kind exchanges. Interest in real estate for interest in real estate. Well, she closes her sale. She doesn't have a new property, so she has what's called boot. And she has two types of boot. She has cash boot. So if I'm paying off a $40,000 loan, I'm going to have $60,000 net equity. The 60 is what I would walk away with in my pocket if I was selling. So I have cash boot, non-like-kind consideration of $60,000 cash, and I have $40,000 mortgage boot, from paying off the loan. The phrase is you offset the boots received by boot given. So I go out and I buy a $100,000 property. I put my $60,000 net equity cash boot towards the purchase. I have to do that. I could choose to refinance the next day and pull out the cash if I wanted to, but I've got to use that cash to buy. Then, as for the $40,000 mortgage boot, Sally's got a choice. Normally, Sally would go out and get a new loan. Usually it's a bigger loan because they're going up in value because they've got excess appreciation. But so Sally goes out and get a $40,000 new loan, offsets the loan she paid off. She could choose, and after 2008, I did have a couple of folks want to do this. I know I got to use my net equity, but I don't want any new debt, or they're retired, and I don't want to pay tax. Well, they happen to have $40,000 in their piggy bank, so to speak. They could use the non-exchange cash in lieu of getting a loan. So those are the boot offset rules. From what I understand, the deal with the boot is two farmers walked out to a fence, and they're going to swap each other's land. And Harold's land was worth more than George's farm, so George threw in his boot to equal the value. So I don't know if that's true. I like telling that story, so that's the myth I've been spreading.
I've always looked at this exchange and the way it was kind of initially explained to me. The QI was also referred to as the facilitator. The idea was that the owner of the investment property that was being sold was not to ever put their hands on the money that was the gain. It was to go to the QI or facilitator and then be rolled into the next property. And that was really what it was all about, that it never went through the hands of the owner. And that's correct, right?
What sometimes people don't realize is they call up and I closed last Friday. And what do you mean close? Oh, did you record? Yeah, we recorded Friday. Money is still at escrow. Well, fortunately, by the safe harbor rules, that's why you got to have a QI facilitator, accommodator by the time you close your sale is constructive receipt. So the escrow agent is an agent, and the concept of the agency is constructive receipt. Whatever an agent is deemed to have done or received is deemed to be done or received by the principal. So the escrow agent has the funds in their trust account as of Friday, but Sally is in constructive receipt of those funds, so technically outside the safe harbor. And then the important thing that comes up with that we have to hold the funds is how can a client be assured? I always want clients to sleep at night, and how can they sleep at night knowing that we or any other QI can't steal their money? Because about 20 years ago, there was a guy that went around the country buying up exchange companies that had pooled trust accounts, and he embezzled hundreds of millions of dollars. And everything collapsed. He thought he was going to get the money back in time, and tens of thousands of taxpayers lost their equity, and had a taxable event because they couldn't buy. And rightfully so, a lot of people said, well, who the heck are these QIs that are holding my money? So I and some other lawyers a long time ago asked the state legislature to require each facilitator in Washington state. Unfortunately, few follow this. We do nationwide because I want our clients to sleep at night. So there is the means to protect a client's funds from the QI stealing the money, and it's just business, nothing personal, is by using a qualified escrow agreement, a QEA, 3 parties to it, the facilitator's bank, the facilitator company, and the client. And the bank agrees that the bank will only release money. And so the money is beyond the control of the facilitator. We never have unilateral control over the money, so we can't steal it. That means that the sale escrow would wire directly into a segregated interest earning trust account, and all the interest is supposed to go to the client. So escrow wires it in directly. We don't put it into the client's account. And then the bank agrees the bank will only release funds from their segregated account when the bank receives written signed authorization from the client directing the bank to release funds. And usually there are only 2 disbursements, earnest money. So Sally needs to send $20,000 to Chicago Title and Puyallup because that's where Judy, you helped her find the replacement property. And then, a month from now, we're ready to close and we wire out the purchase proceeds. Ordinarily, those are the 2 disbursements. And that's how, the clients can sleep at night, because we never have unilateral control over the funds.
Well, that's good to know. I was not aware of that either. I'm learning all kinds of things today.
Richard, we work with people who are downsizing or right-sizing, as we like to call it. Let's give a scenario that the homeowners have found another property. They want to make it their primary residence. They've moved in. They're going to take their old residence, they haven't sold it, and make it a rental property. Does it have to be a rental property for a certain amount of time before they can make an exchange?
Yeah, that's a great question, because the phrase that the code says you acquired, which means, okay, I'm recharacterizing a property for trade, business, investment purposes. Okay, I bought it outright like that. Or, suggest Dennis is, they're going to turn it into a rental. That's like the same thing as they just bought it as a rental. So now they're holding it for trade, business, investment purposes. How long do they have to hold it as a rental before they can sell it as an exchange? There is no safe harbor time period. So unlike the primary residence where if I live in it 2 out of 5 years, so I can live in it and 3 months here and 4 months there, so forth. 2 out of 5 years is a statutory time period. There is no statutory time period to determine or sustain what is the person's intent. So the only thing the IRS sees are tax returns. And generally, again, so that people can sleep at night, if it were me, I would want to file a couple tax returns. So I am now in April of 2023. I've converted my residence to a rental. The tenants are moving in May 1st. I would file a 2023 tax return showing income and, most importantly, depreciation, because you can't depreciate a primary or secondary residence. Therefore, depreciating a property is objective evidence that it's trade, business, investment. And absent unusual circumstances, that's one of the asterisks I mentioned earlier, I would want to file a 2024 tax return likewise showing income and depreciation, and then I consider selling. I always presume the IRS audits transactions. I've never had a client audited. I know a lot of facilitators, and one of my very good friends, I think Ron had one client audited, and we're talking 30 years. But again, you always presume they're going to be audited, so you want to sleep at night. Similar to that sort of situation is a person buys a property, and I've had clients, and I give you a lot of examples like this, 6 months later. So they bought it in December, and now here we are, we'll say we're in May, and in one instance, a client got an unsolicited offer for like $100,000 profit. And he called me and said, hey, Rich, what about this? I'd like to do an exchange. There is no statutory time period. The client acquired the property with the intent to hold it, but at the time he acquired it, he didn't know about this unsolicited offer that came in a written form. So there's evidence But that written offer came after he acquired the property. And, trade business investment, well, he's getting a payday on the investment. He decided to go forward with an exchange, and then I encouraged him, which was his plan anyway. What he did acquire next is to hold on to it so you don't begin to look like a dealer, because theoretically you can't flip a property in an exchange. I buy it, I fix it up, and I flip it. But really, factually, telling the difference between those two situations, my client who bought the property intending to hold got an unsolicited offer 6 months later, and the client who bought the property, put the new carpet in and so forth, and we're now 6 months later and wants to sell it, their tax returns look the same. They're factually different, but they look the same. So, a person has to decide how aggressive they want to be with, in the latter situation. I had another situation, a client built a home on relational land. And by the time he got it completed, the county council prohibited short-term rentals. Well, that blew his whole plan. And again, he could objectively establish that county action, legal action, occurred after he started his property. But the IRS never even questioned it. But you always want to sleep at night. You want to do your deal in the light of day. And if you plan ahead and you're patient, you can accomplish your goals in the light of day and sleep at night. And I've said that little phrase for 30 years because it's true. You can accomplish, normally the code doesn't get in the way of the deal.
So you mentioned Airbnb just now, and that's something you hear a lot. People seem to be really, and I mean, there's a lot of problems in terms of neighborhoods and cities and counties and whatnot restricting the usage of properties anymore as Airbnb. Does that affect the 1031 exchange? I mean, it's not rented out full time normally.
Well,
it can come and go.
Is no, because clients will buy seasonal property. They'll buy a property that is strictly winter or strictly summer, trade business investment. I don't file tax returns. So what I say to the client who's considering this, short-term rental, it's not just that you're getting income, because you could, as I always like to say, I watch the Masters golf tournament, and I don't golf, but I like it. And I know of people who will rent out their home because they can make $100,000 in a week just renting it out. Okay, so they got to declare that income, but that didn't turn their home into an income property. They can't depreciate the home because it's still their primary residence. So what I say to folks, as I have throughout my practice, whenever there's a income tax question, is talk to whomever does your taxes and tell them, I'm thinking of doing this. What's it going to look like on my tax return? Because in my mind, the key you want is depreciation, because that's objective evidence that it's not primary or secondary residence. So the question simply is, how much time do I have to rent this so that, and you're required to depreciate income property. What is that threshold? I don't know the answer to that, but that's what I always suggest a party who calls me up and says, hey, I'm thinking of doing this like you just proposed, Judy. I say, talk to your accountant, find out if it were me, what do I got to do to have depreciation? Because then I can sleep.
So what if you have a home where you've turned it into a duplex and you're living upstairs and downstairs is a unit that you're renting out? And I'm assuming that you can depreciate that portion of the square footage of the home. What happens in terms of 1031 and capital gain and all of that if you go to sell that home? You've used part of it as investment on a long-term basis, or maybe not, maybe short-term, and the other part as your residence. How does that work?
Well, there is as if I own two properties. It's just they happen to be maybe share a wall or a ceiling or a floor. I own a residence, I own a rental. If I own and this comes up surprisingly, your facts do come up to you. And I got another scenario about that related. Sally is selling her duplex. She's going to take her primary residence exclusion for her unit that she lives in, just like she would if it was on, a residential street, and then treat a rental unit as an exchange. Another scenario this comes up in like Hollywood Hills and Woodinville. People bought their property back in the 70s as acreage. Well, the area's grown and the developer comes along and says, well, Sally, I want to buy your 5-acre property and Sally's living on it. What about that? And essentially, it is the same thing. It's a duplex that she has portion of the 5 acres is her home and the yard that she waters and, fertilizes. And then I'll just say there's a fence. It doesn't have to be a fence, but the goats and the horses are on the other side. That's just acreage. And that's just like path of progress land. I did an exchange for a gal 30 years ago. She inherited a lot of Woodinville from her dad. And her phrase was path of progress. She had held it for a long, long time, just raw land. I don't want to screw around with tenants and toilets. So Sally is selling her whole unit, her whole property for $3 million. And then it's just a matter of prorating, like what do you want 2 plus 2 to equal? How much can she allocate to her residence? And then the balance to the acreage as an exchange, even though it's all one real estate transaction. It effectively is 2 different types of property. And that comes up, I've got one that just started and it will probably close a year or so from now, the due diligence and all that stuff. But that's how you would treat it.
So there's a lot of avenues to consider, especially, for someone who is downsizing and maybe they have that big piece of property. In fact, I'm thinking my neighbor just down the street here just did that. They sold the whole front of their property to a developer, and it didn't even cross my mind to think of that as a 1031 exchange.
Well, this is why I like this stuff, Judy, because I get to screw around with these fun little topics, and that's why I liked exchanges in law school. Edit out my language there, by the way. Sorry about that. I get excited.
Richard, are there any other strategies that can save homeowners?
Well, yeah. Here's the 2 ways you can beat the tax man. One is from the grave. You can do. I have clients who have done a series of exchanges, one after another over a period of years. Occasionally I get elderly people. I'm 66, so that's not elderly, by the way. They're 105 years old, all right? And they've made the business decision to sell, and they're going to buy a new property with an estate plan in mind. They've got 3 children, and they're going to go buy 3 properties that for, Tom, Sally, and Bob are each going to eventually inherit each of those properties. So by Sally, who now is 104 years old, the fact that she did an exchange into new property, then when she dies, her heirs get a stepped up basis. So whatever was the gain, and again, it's not profit, but whatever has been the cumulative gain over the 30 years she's on real estate under current tax law gets wiped out because the basis is raised to whatever the market value of those properties are on the date of Sally's death. I do cringe at times when Sally instead makes a gift to the children before she dies. That's not the best way to structure it because the donees take her basis. So you can beat the tax man from the grave. The other is to recharacterize the property as a primary residence. So, I'm selling my Linwood property and I'm buying the Maui condo and I'm going to rent it for a couple of years, file a couple of tax returns to substantiate that, I did in fact do an exchange, and then I'm going to move into it. And the time period is a little different than the clear 2 out of 5 years, but essentially I can then recharacterize that condo in Maui, a rental, into my primary residence. And a few years down the road, I can sell that condo as my residence and take my allotted gain tax-free.
So what is the proof the IRS uses to prove that you actually moved in, lived there? And
well, it's tax returns. That's all they see. They don't, even an audit, they'd have to go real deep into, they'd have to go utilities. I mean, it would be a very deep audit to find that. So all the IRS ever sees are tax returns. They don't see the settlement statements. They don't see any of our documents. Therefore, is why I would want to have the depreciation, because then the profile of my exchange fits the little boxes and the red lights don't go ding, ding, ding. Yeah, ultimately, I think it's depreciation, or you got raw land. I had clients, this is the last real estate boom, several of them bought properties in Bellevue and they weren't suitable for rentals because they were the white carpet stuff. Well, they kind of treated it like raw land. It wasn't a second residence. They just held it for appreciation purposes, and they did their exchange, and I've never heard back. I presume a client would call me if they had a problem, but they haven't. And that's my dog starting to bark, by the way.
She must hear mine.
He's a stinker. Yeah, he's the IRS coming in to give me the what for.
Richard, can you kind of clarify what the 2 and 5 year rule is?
Yeah, so that's for primary residences. I have to live in the primary residence 2 out of 5 years. And if I hit that 5-year mark, then I can sell and I get my $250,000 of gain tax free as an individual. Married is $500,000. And I don't know how long you have to be married to make that $500,000 work. Again, I don't do tax returns. I don't know if I get married and for 3 months and then sell. I don't know how that works. But that wouldn't be in the light of day. Yes, Libby. That's the IRS coming and knocking on my door.
That pretty much covers it.
We've covered a lot of stuff here.
We did. I mean, it's very confusing, and that's why you always need to have. I mean, this is not something you can do by yourself because you can't touch those funds, and that's what this QI, what Richard does, and he makes sure that it flows smoothly from property A to property B, whichever direction it's going. Just out of curiosity, would you mind letting us know about what the cost of something like that looks like?
Most important to a successful exchange is working with a real estate agent that they trust and that the agent can communicate with the principal in a fashion that's useful for the principal. Really important that they work with an agent like you, Judy, that they trust and is knowledgeable about the market. Because of this 45 days, this time period, very rarely does an exchange fail. So I said earlier, the person's afraid, what if they don't find a replacement property? If they've done their work before they listed, working with their agent, what's the price of my property? What's my market value for my property? That's all I'm going to get is market. Then I know my net equity. And with the agent, you start shopping for the replacement property. And I say to the prospective client, like when you call Judy and you say, Sally, I found the property you're looking at. I tell Sally, you got to drop what you are doing right now and go look at it, or else you're not going to get in contract and you're going to run out of clock. And occasionally I've had folks say to me, well, why did the agent say I should pay that much? Maybe they only want the commission. Well, then because the principal didn't trust the agent, the principal hesitated and they ran out of clock. So really, really important is you got to work with an agent whom you trust, and you got to be clear with the agent, price, type, location. And then when the agent says, hey, I found it for you, you drop what you're doing and go get to it, or else you're going to run out of clock. So that's just really important. So generally, we've charged $1,000 for an exchange fee for a long time. We're not the cheapest out there, but I know nationwide, we're very competitive. There are less expensive outfits. But I say to the prospective client, by the time you get through your real estate transaction, your commission, and I'm not complaining about commission. Good agents earn their fee. And I used to be a commercial agent, so I say that with intensity. You got your excise tax, which now has gone up again. The exchange fee is a drop in the bucket. It really, it just isn't, and it's a business expense. So I've got folks who are saying, well, I don't know if I'm going to find a property. I don't know if I really want to find a property, but I am, I'm in contract to sell. So I've lit the firecracker, so to speak. And they'll say, well, so I'll pay the exchange fee so that they can keep their option open to consider it. Because again, it's a drop in the bucket compared to all the other real estate transactions. The fee for a QI, and I have folks who get all wrapped up about that. And that's unfortunate because I think they're missing the big picture here. And reverse exchanges are more expensive also. I've never had a client turn it down because of the fee. If they can't do a reverse exchange, it's because of other factors, not the fee. And then you can get an additional fee for subsequent properties as well. There's additional coordinating with escrow. If I'm selling a second property, I'm buying a third property, you should expect to pay an additional fee for those separate transactions. And again, you should get all the interest on the account.
Right. I mean, it's more work. It just makes sense. If you go to the dentist and they fill one tooth, it's much. If they fill two teeth, it's more. So,
Yeah, my wife has a lot of crowns. She's very royal.
well, I've learned. I mean, I'm very excited about that reverse 1031. I wish I'd known about that sooner. I think we're heading back into another one of those crazy markets where that's a way to make sure that you've got the property that you want and you know yours is going to sell. When you're in that kind of market, that's wonderful.
The reverse really, again, you prefer to sell and buy. But the scenario of the principal who's working with their agent, so okay, they decided what's the market price for the list, and they're getting the property ready to get on market and all that, and then that principal is working with their agent to go look for replacement property. Now you could be 1 to 2 months out on this time period before you close your sale, and you're out looking. You want to find that replacement property. You don't want to be afraid of a reverse because it ain't done till it's done. And if I'm out there and I have found my replacement property, man, I don't want to let that go because just don't find those every day. So the reverse it's a good thing. It's a good thing because that's if they're being diligent, they're out looking for property. They really should find it if they're looking with their agent and they know what they want. They should find it in that time period. Very few of our exchanges, I'd say over the 30 years I've done this, I mean, not more than 5 a year fail. And that's because they never really knew what they wanted, and an agent can't help them then.
And just an FYI, and I'm guessing that you still do this, but in the past when I've recommended people to you, you answer questions for them up front.
Oh, yeah. Absolutely. We charge a fee for that. Absolutely. It's 206-522-1031. I always love that. I bought that number 30 years ago for $500 and has the best marketing thing. Yeah, 522-1031. It's always call it, forward it to my cell. And so if you see a different number, it's just because it's my cell. But the 1031 ground line is easy to remember. And I don't charge for consultation, so I'm happy to take questions. I enjoy talking about this.
That's wonderful. That I've always appreciated that you did that.
Sure, you bet, Judy. It's always a pleasure working with you.
Thank you.
Richard, do you have a website?
Yes, it's Richard at Free Tax Exchange, www.freetaxexchange.com. I have a brochure there that summarizes a lot what we've talked about today. And current contact information is there in the 522-1031. You always can feel free to call me. I'm happy to talk to folks, whatever. Because I try to help people discern what is in their best interest. And if they've made the business decision to sell and buy, and they, other than a primary, secondary residences, and they've got 10 to 15,000 in taxes, I think it's a no-brainer to start it as an exchange. Then they got to work with their agent to go find that property. That's the real deal.
And we will post your contact information on our website and on Spotify.
Well, thank you so much. Appreciate your coming and being a guest on this.
Yes.
A lot of fun.
And hopefully this sparks some ideas in people that a way to exchange properties to make something work for them and save some tax burden there.
But what starts the process is the principal makes the determination they want to sell. They come to that business life decision. They want to sell. That's what kind of starts the rest of the analysis. They make that decision first, and then it flows from there.
That's it for episode 13 of the Edge Group podcast, Getting Your Edge, How to Right Size Your Home and Life. I hope you learned something that might help you in the business world. For all you listeners, we have and watchers, we have a YouTube channel as well. You can go to our website, www.edgegrouprealestateservices.com. You can get every episode of our podcast and the episodes that are on our YouTube channel. Thanks, Judy, for coming.
Thank you, Dennis, so much.
That's it, folks. Thanks for listening, and stay tuned for future episodes wherever you get your podcasts. Thanks. Goodbye.